how to trade using trend lines. So what you'll learn from this video is first, how to actually draw them properly, and second, how you can utilize the trend lines to find high probability trade setups. So without further ado, let's get on with the video. First of all, what are trend lines? So trend lines are simply key levels that are formed in a trending market. And the reason we draw them is because usually when the price approaches these key levels, it can offer you multiple high win rate trade opportunities. For example, in a trendline strategy, there are two types of patterns that may form when price approaches a trend line. The first pattern is called the continuation pattern, which is formed when the price bounces back to the direction of a trend right after hitting a trend line. And the second pattern is the breakout pattern, which is formed when the price broke out of a trend line, causing the trend to switch directions. Now remember, just because the price hits the trend line doesn't guarantee that a trend change will occur. You need to use additional price action techniques to confirm your analysis, which I will discuss later in the video. So now, I'm going to show you a simple way of drawing trend lines effectively. One of the most common questions that beginners ask when drawing trend lines is, should you draw them hitting the wick's end, the candle's close, or the candle's body? Well, the answer is, you want to draw them where it can get you the most amount of touches as possible. Let me give you an example. In this chart, we spotted a current uptrend as prices made higher highs and higher lows. Now, because this is an uptrend, it means you want to place your trend line below the trend. Then, you want to adjust the trend line to get as many touches as possible. Now, notice that there are some points that are overlapping the trend line, and even some that are not touching the trend line at all, which is perfectly fine, because remember, a trend line is supposed to be treated as a general area, just like support and resistance. So let's look at another example. Here, we spotted a current downtrend as prices made lower highs and lower lows. And because this is a downtrend, it means you want to place your trend line above the trend. And again, you adjust it to get as many touches as possible. And so it's that simple. So now that you know how to draw trend lines effectively, it's time to go in depth into how you can utilize these trend lines to find high probability trade setups. So first, let's start with the continuation pattern, which is a pattern that occurs when price bounces back to the direction of a trend right after hitting a trend line. Now remember, you cannot immediately take a position just because the price hits a trend line. You need to use other price action techniques to confirm your analysis. And a good technique that you can use to confirm a continuation pattern is by drawing a mini trend line right at the pullback. The next step is to wait for the price to confirm the continuation pattern by waiting for it to break out of the mini trend line. Once the pattern was confirmed, you take a buy position. Let's look at another example. In this chart, we spotted a downtrend, and so we place our trend line above here. Then, as we look at the current price, we spotted another possible continuation pattern. So the next step is you want to confirm the continuation pattern by drawing a mini trend line at the pullback. And once the price broke out, you take a sell position. Now, another indicator that can also help you confirm a continuation pattern is the stochastics. Here's how the strategy works. In this chart, we spotted a current uptrend, and so we place our trend line below it. Now, as we look at the current price, we spotted a possible continuation pattern as price hits the trend line. And at this point, notice that the stochastics is at the oversold level. And so you want to utilize the stochastics to help us confirm the continuation pattern by waiting for it to cross back inside the oversold level. Once the pattern was confirmed, you take a buy position. So let's look at another example. In this chart, we spotted a downtrend, and so we place our trend line above the downtrend. Next, as we look at the current price, we spotted another possible continuation pattern as price hits the trend line while the stochastics is at overbought. And so we want to wait for the stochastics to confirm the continuation pattern by waiting for it to cross back inside the overbought level. And once the pattern was confirmed, you take a sell position. Now, moving on to the second pattern, which is called the breakout pattern. This pattern forms when price broke out of the trend line, causing the trend to switch directions. So again, you cannot take a position just because the price broke out of a trend line, because it doesn't guarantee that a trend change will occur. You still need additional confirmation to avoid false breakouts. And one of the ways you can do this is by looking for signs of momentum loss before the breakout. Let me give you an example. In this chart, we can see that the price is on an uptrend, and so we draw our trend line here. Now, you can see that the price were making higher highs. However, when we looked at the latest price action, the price suddenly made a lower highs instead. What this means is that buyers failed to push the price higher, which is a sign of momentum loss. Then, we saw that the price broke out of the trend line, which further confirms the trend change. So this is a good opportunity to take a sell position. Let's look at another example. Here, we spotted a downtrend, and so we place our trend line above it. Now, notice that the price were making lower lows before suddenly it made a higher lows instead, indicating that a downwards trend was losing